Welcome to The Explainer, everyone. Today, we are diving into what is arguably one of the absolute most fascinating situations in the Indian equity markets right now. Vodafone Idea, or V. We're staring at the ultimate telecom paradox here. On one hand, you've got a stock that's just been surging, grabbing a ton of retail interest. But on the other hand, we have a company carrying an existential debt burden that literally threatens its very survival. So let's just dive right in and untangle the reality from all this hype. Welcome to Stress-Free Investing Analysis, Personal Notes. I am not a CB-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a CB-registered professional before making any financial decisions. All right, here is our roadmap for today's explainer. We're going to cover the VI paradox, operational green shoots, the core financial squeeze, red flags and shenanigans, valuing the turnaround, and finally, our final verdict and scenarios. We're taking a strictly data-driven approach to just, cut through the noise. Okay, let's kick things off with part one, the VI paradox. So we have this massive, glaring conflict right now between a euphoric market narrative and absolutely terrifying financials. Just ahead of this May 2026 report, VID's stock price rallied a massive 46% in a single month. The market is clearly pricing in some sort of miraculous turnaround. But then you look at the objective quantitative scores. We're talking a Piotrowski F score of 1 out of 9, which signals extreme financial weakness, and an Altman Z-Score of -2.1, putting it firmly in the deep distress zone. Guys, this isn't just a minor discrepancy. It's a massive chasm between market sentiment and cold, hard mathematical reality. Moving on to Section 2, Operational Green Shoots. Now, to really understand this crazy rally, we've got to look at what's actually going right. Notice the trend here. Vodafone Idea has delivered 19 consecutive quarters of growth in average revenue per user, or ARPU. As of Q4 FY26, they hit 190 rupees. Make no mistake, that is a solid, real operational victory. But, context is everything. They still significantly lag behind Jio at 214 rupees and Airtel at a commanding 257 rupees. So yes, V is improving, but their pricing power, it's still the absolute weakest in this oligopoly. But hey, ARPU isn't the only green shoot we're seeing. We've had 3 massive positive catalysts hit recently. First up, the existential threat of adjusted gross revenue, or AGR dues, was finally crystallized by the government at 64,046 crore rupees. That's actually a 27% drop from previous estimates, which is huge. Second, the Aditya Birla Group stepped right back in, committing 4,730 crore rupees in fresh equity, with Kumar Mangalam Birla returning as chairman. Talk about a massive signal of promoter confidence, right? And third, for the very first time since the merger, monthly subscriber additions actually turned net positive in February 2026. These are genuine turnaround hopes we're looking at here. All right, let's pivot to Section 3, the core financial squeeze. Because at the end of the day, hope just doesn't pay the bills. 19,003 crore rupees. That is V's reported EBITDA for FY26, and it comes with a pretty healthy-looking margin of around 42%. On paper, before you really dig any deeper, this tells you that the core telecom operations of Vodafone Idea do actually generate cash. People are paying their phone bills and the core business is functioning. But here comes the hammer drop. 22,976 crore rupees. That is the company's interest cost alone for the trailing 12 months. Just let that sink in. The crucial takeaway here is this. These interest costs entirely consume its operating earnings and then some. The core business literally cannot even fund its own debt service, let alone pay down the principal, and let alone invest the 15,000 crores a year in capex it desperately needs to keep up with Jio and Airtel's 5G rollout. We're looking at a classic structural debt trap. And that interest? It's servicing an absolute mountain. Via owes roughly 2 lakh crore rupees in total government dues, split between AGR and spectrum payments. The bank debt is actually pretty negligible at this point. Banks have largely exited the chat. Almost the entirety of this existential weight is owed straight to the government. It's the immovable object just sitting heavily on Via's balance sheet. Which brings us to Section 4, red flags and shenanigans. When you have a debt trap this deep, the risks just multiply. And let me tell you, the scorecard here is blinking bright red. First off, VO has a deeply negative net worth, with reserves sitting at negative 1.4 lakh crore rupees. Second, just to survive this long, the company's diluted its equity base by 33 times over the last 11 years. Your slice of the pie just keeps getting more and more microscopic. And as a part of all this, the government has converted dues to equity and now holds a massive 49% stake. This really complicates things because VO is no longer just a pure commercial entity. It has massive policy exposure. And the ticking time bomb in all this? Starting in FY27, massive spectrum obligations of 10 to 15,000 crores a year start hitting the books all over again. And hey, if you don't want to take my word for it, just listen to Deloitte, their Big Four auditor. In the FY25 report, they dropped an emphasis of matter, explicitly stating companies' ability to continue as a going concern is dependent on DOT AGR support, successful fundraising, cash flow generation. A going concern warning is quite literally the most severe red flag an auditor can wave. It means the experts reviewing the books are genuinely not certain the company will even survive the next 12 months without some sort of external rescue. Let's move to Section 5, Valuing the Turnaround. So how in the world do you invest in a company like this? Traditional metrics are pretty much useless here. If we generously value their telecom operations based on pure multiples and add in the immense strategic value of their 5G spectrum assets, you get roughly 2 lakh crore rupees in total enterprise value. But remember that debt mountain we just talked about? You have to subtract the roughly 2 lakh crores in net debt and government dues. So what's left for the equity shareholders? Pretty much nothing. The implied equity value is fundamentally just 4 to 7 rupees per share, yet the stock was trading near 14 rupees. That current price is entirely a premium based purely on the hope of a miraculous turnaround. And finally, Section 6, Final Verdict and Scenarios. Which brings us to our conclusion. For that 14 rupee stock price to actually make sense, for this bull case to become reality, VIA has to execute 3 monumental steps perfectly and simultaneously. First, they absolutely must close the 35,000 crore bank funding they are currently negotiating. Without it, the network just dies. Second, they have to push that ARPU past 250 rupees without bleeding their subscribers over to Airtel and Jio. And third, they need the government to step in yet again and restructure that upcoming FY27 spectrum debt, simply because the operating cash flow won't cover it. So, what are the actual odds here? We frame this as a probability-weighted binary bet. We assign a 55% probability to the bear case, meaning funding fails or falls short, and the stock collapses right back to its fundamental 4 rupees a share. We're giving a 30% chance to the base case of reaching 18 rupees and only a slim 15% chance to the miraculous bull case of hitting 28 rupees. When you weight those probabilities, the fundamental value sits right around 12 rupees. With the stock trading higher than that, the risk-reward is heavily skewed to the downside. Our final quantitative score comes out to 16.2 out of 100. That's a grade F, guys. The verdict here is a void. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay up to date with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below and it might be the subject of my next video. Thank you for watching and keep your investing stress-free investing.